everybody. A very warm welcome and good morning to all on Tuesday, the 31st of May. Richard Clippen here for our FSC Connect series, which continues to try and deliver and hopefully does deliver some of the best thinking and the best thinkers connecting the financial services and the broader sector together. I think, as everyone knows, we've been trying to do this over the last 2.5 years through COVID, and it's been a fantastic way to really connect everyone, keep on point and on message in terms of the key issues facing Aotearoa and New Zealand. I'm delighted this morning that we have the Deputy Governor of the Reserve Bank, Christian Hawkesby, in his first session with the FSC since his new appointment. We forged a really strong and collaborative, productive relationship with the Reserve Bank now over a number of years, and it's fantastic to have Christian join us. It's really follows on from the May economic statement, so there's a lot of depth to get into and discussion with Christian about the outlook for New Zealand, the current state of play and the state of affairs. So absolutely in for a treat. I'm going to introduce Christian in just a moment, but before I do that, wanted to warmly welcome Rob Flanagan, Chair of the FSC, just to say a few words. Rob, over to you.
Thanks, Richard. And Christian, just on behalf of the board, we really appreciate you taking the time out, and especially this is your first visit, I guess, or first presentation, but we do really appreciate the time and the insights that you give, or that the Reserve Bank has given to the industry through these sessions. So thank you, very much appreciated, and I'll hand back to Richard to get it all underway. Thank you.
Thanks, Rob. Folks, as ever, these sessions are as interactive as possible. Please feel free to use the Q&A button and the chat button if you have a particular question or you'd like to steer the discussion in a particular way. The way we're going to run today is that I'll introduce Christian in a moment. He'll then speak for 5, 10, 15 minutes, just give us a bit of an overview, followed by a bit of a fireside chat. So an informal opportunity to discuss a range of things. As ever with the FSC, we are on the record. So welcome to all of the members of the Fourth Estate who join us today. We will be recording, and post the end of the day, we will look to turn this into content that sits on the FSC YouTube channel for those who want a second look, and perhaps for some who may have missed it. So without further ado, let me warmly welcome Christian Hawkesby. Christian is the Deputy Governor of the Reserve Bank. He's been with the RB since 2019, was a key part of the Harbour Asset Management team, and prior to that had a number of years in the UK with the Central Bank of England. So comes to us with a great amount of experience, both in central banking, but also in the funds management sector. So really looking forward to this discussion. So Christian, perhaps without further ado, let me welcome you formally and pass the baton to you.
Thank you, Richard, and thank you, Richard and Rob, for the warm welcome this morning. Morena koutou katoa, everyone online. It's a real pleasure to be here. Just want to acknowledge the relationship that the Reserve Bank's had with the Financial Services Council, a very strong relationship and a really great way for us to connect with the industry. Really looking forward to your conference later in the year, Richard, where we can get more onto the sort of regulatory agenda. But I thought, as a way to sort of kick things off with our monetary policy statement out last week, it would be good just to set the scene and have a bit of a conversation about the economy and the way that that's feeding into the financial system as well. I'll just say a few words to open things up, but very much the value here, I think, comes in the Q&A. So please, through my intro, just think of some questions that we can take the conversation a little bit further. I thought I'd talk about the 4 phases, effectively, that we've had since COVID struck, and sort of explain our approach through those different phases and how it really leads into where we are today. So I think, if you go back to the beginning of 2020 when COVID first struck, and think about that as the first phase of one where we were in an environment of extreme uncertainty, one where central banks globally, through the idea of forecasts and projections out the window, and really felt that we were in an environment where we were just looking at different scenarios in an environment that we were completely unfamiliar with, the domestic and global economy effectively going into lockdown. So through that role, through that phase, we saw our role as one of bringing cash flow and confidence into the system through a number of channels. One, through ensuring that financial markets were functioning and had plentiful liquidity. For the economy, having interest rates as low as we could take them to sort of cushion that initial blow of COVID, and that meant lowering the official cash rate and using a range of different alternative tools to effectively bring interest rates down across the curve, very much in a supporting role to fiscal policy, which was really in the lead through that phase. And then finally, for the financial system, just ensuring that the financial system and what we were doing in that space wouldn't be an obstacle to the recovery. So taking away a lot of the restrictions that we had in place, putting the regulatory agenda on hold, just so that the financial institutions could focus on supporting their customers through that phase. And through that period, we talk a lot about least regrets at the Reserve Bank, and it's just sort of an acknowledgement that the world is always very uncertain, and we know that we won't ever get it completely right. But what is our least regret? And through that phase, it was doing too much rather than doing too little. Given the amount of uncertainty and coming through from a period where inflation had been very low for a very long period, and we were really had a genuine threat of finding ourselves in a deflationary environment that would be very difficult to fight our way out of. So I think as we went into the end of 2020, we went into a different phase, which I'd sort of describe as things not being as bad as we feared, a lot more resilience in the demand side of the economy, particularly given the success of the wage subsidy, which really connected workers with their businesses and really kept that sense of job security. So we saw spending and consumption continuing on. We had surprisingly had very strong export prices, so our terms of trade, the income of the economy was strong, and the housing market was resilient too, in part because many Kiwis were coming back coming back to New Zealand through that phase. We were one of the few economies globally who was actually able to take economic activity back up to pre-COVID levels reasonably promptly. But we were still cautious in that we hadn't had COVID in the community. We weren't sure how the economy and financial system would cope without the sort of life support that it had been on. And so took a view that our least regret was to keep stimulus in place for too long rather than too little, just to help us confidently through that phase. As we went into last year, a new phase again, the third phase, if you wish, where we really started to get a better handle on the economy. We got into a position where we felt we were out of that extreme uncertainty of the beginning of COVID, and actually had the confidence to be one of the first central banks globally to start putting out projections again for the way that we saw the economy evolving. And one where, given the resilience of demand, but also these supply side constraints that were starting to come through from COVID, one where we saw ourselves moving in an environment where we could start removing some of the stimulus that we'd put in place. And that really started happening from the middle of last year, where we put out those projections, sent those signals, and we had mortgage rates, particularly fixed term mortgage rates in New Zealand, rise substantially through the middle of last year. And that was really the beginning of that phase of removing stimulus. And it was one where we were at that point really out on our own with other central banks globally, still much more in the mindset of keeping interest rates low for a prolonged period. So finally, we move into 2022 and effectively to where we are now. I think the key themes there are just continued resilience in the demand side of our economy, including resilience through this period where we actually have had COVID in the community, but also much more persistent supply side constraints. So not only those that have lingered through the impact of COVID and further into this year as China has gone into lockdown and further disrupted supply chains, but as you all know, the supply side impacts of the war in the Ukraine and conflict with Russia and the way that's disrupted key commodities, key supply chains, and really affected that ability for the productive capacity of the globe to meet the demand side. So we're now in an environment where we have headline CPI inflation at 6.9%, and we expect it to stay, around those levels through the first half of this year. That's a high for the last 30 years, but more importantly for us, we've got core measures of inflation. So that's, stripping out these sort of more volatile influences, sitting at around 3 to 4%. And that's relative to our 1 to 3% target. And also an environment where we've seen inflation expectations creep up, not only short-term inflation expectations, which tend to move with actual inflations, but also more medium-term measures as well. So we're getting in terms of our mandate and what we're asked to deliver on, which is price stability over the medium term, we're getting a very clear message there that we need to continue removing stimulus. In New Zealand, we also are getting the same very clear message from the second half of our dual mandate around supporting maximum sustainable employment, that we need to be removing stimulus as well. We've got a very tight labour market, very widespread skill shortages. We have unemployment at record lows. And when we look at the different range of economic indicators for the labour market and maximum sustainable employment, we look comfortably through. So on both sides of our mandate, both inflation and employment, we're getting very clear signal that we need to be not only removing stimulus and getting the official cash rate up towards 2%, which we see as neutral, but in fact that we need to be tightening conditions to try and bring demand back more in line with the ability for the economy to meet that demand. I think another very clear difference or phase that we're experiencing this year is that last year we felt like we were effectively out on our own, removing stimulus and sending these signals that we were heading back to more neutral settings. Now, with global inflation more widespread and central banks globally shifting into the zone of removing stimulus, we're also in a world where not only New Zealand interest rates are rising, but global interest rates are rising too. And in some ways that makes our job more difficult when we think of interest rate differentials between New Zealand and elsewhere, and where they kind of need to be for the exchange rate to be being helpful for our objectives as well. I quite often get, obviously asked about the housing market and where this fits into the whole story. We've done a lot of work in recent years around having our macroprudential tools and using them, particularly our loan-to-value restrictions, to try and build resilience into our housing market, such that if house prices do get to an unsustainable level, there is a good amount of equity and the buffers that borrowers have there. And we think that over the last period, we have enabled the asset quality of the banking system to improve and to be able to withstand the environments where asset prices fall. Also, banks were testing borrowers through in previous years and at different levels of interest rates, and some expectation that interest rates could rise from those low levels. We think that there will be some borrowers who borrowed over the course of the last 12 months who will need to revisit their consumption plans, and we think that there's possibly a reasonably subdued period of consumption ahead of us in that environment, which is really consistent with demand cooling off to meet the ability of the economy to supply it. Richard, I know that you'll be interested in the regulatory agenda, and a lot of that has come back on track now that we've moved through these different phases and getting back to business as usual. So there's and a lot of that is really built around an agenda for the long-term resilience of the financial system, whether it's the capital of the banking system and the insurance sector, liquidity, strong levels of governance, and the like. So, Richard, I'll just pause there, and I hope that's provided enough of context to get some questions flowing. Thank you.
Awesome, Christian. Thank you. That's I really like the frame up of the 4 phases that we've tracked through. Kind of gives us a really good understanding because I guess one of the things in a pandemic is you have pretty short memories and you face what's in front of you rather than a reflect back. But yeah, I kind of think we all had to manage our businesses, our families, our households with all that uncertainty, and that benefit of hindsight is good. So look, folks, the lines are definitely open. Good questions coming through. I will go to those in a moment. Christian, perhaps just the first one, just picking up, if you dived into the housing market in the last 12, 18 months with a bit of FOMO, you probably, and unless you locked in your rates kind of long term, you're definitely facing into a much higher spending piece on your mortgage. I mean, how big an issue do you reckon that is in terms of people who kind of flooded into the market, worried about missing out?
Yeah, so we have had a look at that, very closely, and I think there are 2 areas that we take comfort around. One is that our loan to value restrictions and putting them back on does provide some equity buffer there, and we know that that's important, and some of that equity buffer would have built up for borrowers who had been in the market for a while as well. I think the pinch points really come from, as you say, those borrowers that entered the housing market over the last 12 months or so when prices were at their peak and interest rates were at their lows. So at our measures, I think we've talked about this in our financial stability report, with fixed term interest rates rising up to around 5%. Once they get to that sort of 5% level, we think about a quarter of borrowers in that last 12 months will be having to revisit their consumption plans, their spending. At 6%, that goes to around a third of borrowers. At 7%, it gets up to about half of borrowers over the last 12 months are going to have to revisit their spending plans. It's not to say that they're going to be under stress, but it's to say that they're going to have to, think carefully about their consumption, and it may, create this environment where we do have, more subdued, consumption across the economy. In some ways, that's kind of how monetary policy works. when you think of it, when the economy's weak and it needs some support, we lower interest rates, and that gives people the confidence to consume and the ability to consume, the cash flow and the confidence. When the economy's running hot, it goes into reverse. We increase interest rates, and that helps, cool things off. We take some comfort from the fact that these borrowers have had their, serviceability stress tested through that period where they were entering the market, and that's one of the key, bits of risk management and resilience that we sort of need to build into the system, such that we can manage the macro economy while keeping the financial system resilient. But we are very, conscious of those second round effects from those borrowers.
Yeah, I mean, two questions that flow from that. It seems like out of the financial stability report, households are in pretty solid shape with their savings. And I guess the second observation and question is, again, in your financial stability report, the market's already come off, both anecdotally but also statistically. It looks like time to sell property, time on market price is starting to come off, but not alarmingly so. Would that all be fair?
No, well, I think on the resilience side, yes, you're right. We do think the bank's balance sheets are in good shape. We do think that there has been that benefit from having loan to value restrictions in place for a prolonged time for them to have some impact. I think also that the benefits of the wage subsidy are still being felt. We put out a lot of analysis around this last year, how that had improved balance sheets, how effectively the household sector had saved a lot through those initial phases of COVID. And so that savings really built up a buffer such that when we move into this environment where those, the life support comes away from the fiscal side, and we start having COVID in the community, consumption can keep going because there is the benefit of that buffer from the savings that did occur through that period. Richard, what was the second part of your question?
Yeah, I think just that point around house clearances and already house prices coming off a little bit, although not alarmingly so.
Yeah, well, we've been talking about house prices becoming unsustainable for quite a while, and our language has sort of shifted. You would have noticed we, at the end of 2020, having taken those said we'd take the loan to value restrictions off for 12 months, having seen how resilient the housing market was and what was going on there in terms of the asset price growth and credit growth, having put those loan to value restrictions back on because the market was starting to look unsustainable. We went through a period where that's effectively stretched out and increased our confidence that not was only the housing market it might look a bit unsustainable, but it was definitely looking unsustainable as we were into the end of last year. So in our May financial stability report, we talked about house prices being somewhere between 5 and 20% away from what you could call a sustainable level. We don't like to put a point estimate on that because there's a whole lot of different measures and metrics and methods that you can use to try and back out what does look like a sustainable level. And we're also conscious that this is an asset price, so very difficult to forecast and has a lot of factors influencing it. In our monetary policy statement last week, our central projection or our sort of working assumption is that house prices have fallen 5% from peak and might fall another 10% over the next couple of years from that peak to get it more comfortably in that range. We think that that's something that the financial system can withstand. It really just puts the level of house prices back to not that far off previous levels. But it does, as I said earlier, it would be consistent with an environment where we have reasonably subdued consumption through that zone, and that's kind of what's needed from a monetary policy sense at the moment.
Fantastic. Look, there's some great questions coming through. I'm going to condense a couple of them because they're around the same or similar point, and this is around the notion of least regrets. With the least regrets policy, has that led to more volatile interest rates? Did we drop too aggressively and rise too aggressively? And is that a fair assessment of what's going on? And any comments on that?
Yeah, it is a really good question, and it sort of gets you into the counterfactual. And I guess just to be clear with the least regrets policy, when we say that in 2020 we were, our least regret was to do too much rather than too little. That's not kind of saying that we deliberately are trying to overcook things, and that we're deliberately trying to aim, away from our target, or to have aim to have inflation above target. It's really just an acknowledgement that we live in a very uncertain environment, and that there are a range of different outcomes that can occur, and we just have to weigh up the pros and cons, the risks and benefits of being in those different scenarios. We don't know where we're going to be in 2 years' time, but we can think ahead and think, well, which scenario would we rather be in if we are wrong? So through that 2020 period, we were very clear that being in a scenario where we had very weak inflation through the bottom of our band, potentially being in a deflationary environment, would be a very hard scenario to work your way out of. One that we had the lower bound for interest rates that could effectively get us, trapped in that environment and sort of fail to deliver on our mandate. So that's the way we sort of think about it. Move into the environment that we're in at the moment, and our least regret is to effectively do whatever it takes to keep inflation expectations anchored at our target, in our target range. And at one point you could say, well, that's going to require us to move reasonably briskly now to give us confidence that we do keep inflation expectations anchored. But actually we may be doing ourselves a favour relative to taking a slower approach, having inflation expectations rise, get stubbornly stuck above our target range, and then we have to lift interest rates to a very contractory level to do the work to get things back in order. And if we go back to that conversation that we had earlier, mortgage interest rates at 8% or 9%, to have to try and do that, you're starting to incur quite a bit of damage in the economy. So that's the way we think about it, not just the here and now, the short term, but the sort of alternative scenarios that we might be facing.
So there's a really good extension question come through from Jared, which is, it seems like the RB is forecasting a soft landing, and soft landings are difficult to engineer. Obviously raises the probability of what's the likelihood or possibility of severe contraction / recession turning up into 23 and beyond.
Yeah, so that's a great question, and what you'll find is that it's very difficult to find economists who will forecast recessions. 2 negative quarters of growth. Typically economists will forecast or project some sort of pathway back to neutral or back to normality, and so it's pretty unusual for any economist to forecast a recession. We are forecasting a period of pretty subdued consumption growth, in part because of what we're doing with interest rates. And we know that we live in an uncertain world, and there will be shocks that come along, positive and negative, and so we can a recession somewhere down the track is well within the realms of possibility. What gives us confidence about what we're doing is our starting point, effectively. When you think, last night I was on a call with all my counterparts across Asia, talking about our experiences and where we were relative to each other. And they're all talking about stories about economic recoveries and trying to bring economic activity back to pre-COVID levels. We're one of the few that stand out saying, well, our economic activity is well past pre-COVID levels. Our labour market is tight. Unemployment's at a record low. We've got a starting point where the economy's, too hot relative to its capacity to deliver on that. And so with that starting point, it gives you more confidence that yes, this is the right type of environment where we can be removing stimulus, tightening a bit, to get the economy on a more sure footing and keep inflation expectations anchored on our target and get the labour market back to a more balanced position.
Yeah, thanks, Christian. A very difficult set of levers to kind of manage in the right order, obviously. It kind of leads to the next conversation, which is, if that's the macro settings, obviously it leads to how households are experiencing it. There's been a lot of talk about the cost of living crisis with rising prices, rising inflation, rising interest rates. I mean, how resilient do you think New Zealand families, whānaus, households are to kind of manage this increase in prices? And I guess the second part of that is, with a really tight labour market, what's your observations on kind of wage explosions taking place?
Yeah, no, great questions, and absolutely acknowledge the cost of living rising and the effect that has on people's purchasing power. To some extent, your second question in part answers the first, in the sense that we are at this good starting point in terms of we've got a fully employed economy, people are in jobs, they've got incomes, and ultimately that's going to be what helps get them through this period. In aggregate, we think that the economy is well placed to cope with higher interest rates. Without a doubt, there will be, distributional issues. There will be different pockets of the economy, different pockets of society that do, feel pain more or less. There will be different, people who borrowed at different times or under different circumstances who will feel the impacts more or less. Monetary policies are, a blunt tool. Inflation, interest rates are blunt tools, and that's where, you've really got to look more to fiscal policy for that sort of distributive, impact, their ability to sort of reach into different sectors, different regions, and provide that type of, support. And that's certainly, what we've seen through. Again, if you go to those sort of four phases of the COVID experience we've had, that the initial phase from the government was one which was widespread economic support, sort of a blanket wage subsidy. Now they're going through a different phase where the support is more targeted, and we feel like that's the right type of phase for them to be in at the moment as well, to address some of these issues.
Yeah, just on borders opening and people and OEs and people coming and going. I mean, clearly there are a lot of anecdotal stories of hospo in pain and you can't find people and it's only half open and so on. On the other hand, you've got the sense of people wanting to get out and rediscover the world. And likely the same is happening where other people want to come into New Zealand. I mean, what's your outlook for labour market, and that movement of people to kind of either feel casual or kind of long-term roles?
No, it's a great question. And it's, one of those unique aspects of this COVID experience with the borders closing and the impact that has on the labour market. And it's certainly, one which has contributed to the tighter labour market. It's effectively one of the ways that COVID has influenced the supply side, of the global economy and the domestic economy, our ability to meet demand. We don't, feel we have any particular expertise in terms of being able to forecast or project the net migration into the future. So we very much take our cue from other government agencies. And over the medium term, we do see the opening of borders as one way that some of this tightness will be relieved if we get back to. I think it's 40,000 per year or 25,000 workers per year coming into the country. That is one of the ways that the tightness in the labour market gets relieved. One aspect is through weaker demand in the economy through higher interest rates. The other is having more workers coming in and effectively we've got the unemployment rate rising back up to around 4.5% as a combination of those two factors. And the short, that's a medium-term story. In the short term, we've got all these dynamics around, the timing of those flows. And as you said, there's plenty of anecdotes of people actually wanting to leave, more quickly, particularly that sort of OE type generation. And so it's a little unclear about the timing and the phasing and the demographics around those sort of aggregate net migration numbers. In terms of our role of setting monetary policy and setting interest rates, in the here and now, we're not putting a lot of weight on the influence of net migration on sort of overall inflationary pressures, and that's because we know that it has both supply and demand side effects. So we have the supply side effect that takes some pressure off the labour market. It can keep wages, more subdued. But equally, if we do have a lot of net migration, we know that there's a strong demand side impulse, particularly when they first arrive and they're looking for houses and housing goods and durable goods. And so when we net those two things together, we think that they roughly net out such that we should be looking elsewhere for what's the sort of marginal impact of what we need to be doing with interest rates.
Yeah, thanks, Christian. I'm going to segue into a couple other areas now, folks. Keep those questions coming. Fantastic. Christian, on the RB's been consulting on the future of money. Feels like through COVID, the stuff that used to sit in the wallet almost became redundant for some people. Just became, call your online shopping and give your credit card. But a lot of submitters. Well, what's your sense of what the future of money looks like, and what did you find out through that consultation process?
That's a great question. It's one of my favourite topics. So we could have an hour on this, but just briefly, what is the future of money? Well, what we've found is that even before COVID, people were using money less, physical cash less as a form of payment, no doubt, and that has been accelerated by COVID too. We're not alone here in the world. There are plenty of countries like us. Scandinavian countries have very strong similarities to what we're going through. So people are using cash less for their payments, but they're still holding cash. The holdings of cash are going up. And the clear message that we're getting through from our consultations is that people like having the ability to use cash. It's important to them. It's a part of our society and the way that we operate, and that we still have pockets of our community that are reliant on cash that aren't served well by the financial industry or just have a preference for using cash, whether it's historic or customary or whatever. So it is important. So we're doing work to try and build a physical cash system that's fit for purpose, that will work in that environment, and people can still have access to physical cash. At the same time, we're doing work on what if we look ahead 5 or 10 years and actually we need an alternative to physical cash where people can have access to central bank money, the money that underpins the financial system, and do we need a digital central bank currency? So we're starting to do quite a lot of work on that. And really what underpins that work is the need for monetary sovereignty in our country. In a world where physical cash is less available, people are using alternatives. If we find ourselves in a world where people are using Facebook money, some sort of private stable coins, we lose control of our monetary sovereignty and our ability to set interest rates that are the right for us and the right for New Zealand. So that's one motivation. And another motivation is that financial inclusion, just making sure that those people who do want to use central bank money for their transactions have that. And we know that privacy and resilience are a key, some of the key factors that we need to think about in that world.
Yeah, it's a fascinating topic that we were talking a little earlier about financial resilience for New Zealanders, and I mentioned that we're running in conjunction with the Retirement Commission the It Starts With Action campaign, which is around financial capability for women. I mentioned this fortnight, we've actually got financially resilient kids. And I guess the question, Christian, we all grew up with, well, I certainly grew up with, you save money, you stick it in a piggy bank. When the piggy bank's full, you take it to the bank, you count it, and then there's a number that hits your passbook account. A lot of research that says if you got cash in your wallet, you protect it a lot more because it's real. Whereas in a digital world, it's just a number on a number in your phone. I mean, what do you think is the connection between helping kids and our community become capable and good with money in a world into the future that might actually not have the physical stuff anymore?
No, it's a great question, and certainly the stage that we're at, as a society, it is the older. When you look at the demographics of the survey results and the feedback that we get from our consultations, it's certainly, there's an older demographic there that still like to use cash. It's what they're familiar and comfortable with, and there's a younger, there's a young demographic as well, where kids where the parents give them $5 to go and spend at the school fair or whatever, and there's definitely that there, and I completely agree that there's something around that sort of tangible thing about physical cash that really does help that financial literacy and for people to understand. And that might be one of the reasons that people have some attachment to physical cash, and it stays around for a while. And we're certainly planning to be in that environment, so we are not planning to get rid of physical cash. We are just preparing for a future where we might have both forms of physical and digital central bank money. I think if the more that we go down the digital route, the larger responsibility there is on places like the Reserve Bank and the Financial Services Council and all your members to be part of that, financial literacy conversation and teaching financial literacy. We I think it's the Life Education Trust that we're involved with, who go around, to schools and engage with that sort of teenage level people. I've been dragged down to my local primary school to talk to them about money as well, and we'll be needing to do more of that, all of us.
Yeah, thank you. Christian, I'm just going to segue briefly into the stability report and the views in there around the consolidation in the insurance sector. And kind of interested in your broader views. There's obviously been a lot of M&A activity over the last couple of years, and just interested in your outlook in terms of what does optimum look like in terms of the life, health and general sectors in terms of ensuring there's competition, multiple players and obviously good access for consumers?
Yeah, I mean, it's a good question, and we sort of need to come back to our, what is our mandate in this space, and it is primarily, in the first instance around financial stability and making sure that we've got a stable financial system that goes for the banking system and the insurance sector, and that's stable both from a prudential regulation and supervision perspective, the individual institutions, and the system as a whole. So we kind of need to look at it through that prism as our sort of primary objective, but not lose sight of, these other things that we need to have regard to, along the way. And it's making sure that our regulation is proportionate, making sure that there's competition, that we have an innovative sector, that we're meeting, financial inclusion needs. So really ensuring that there's a financial system that can serve New Zealanders. That's the prism that we need to look at it through. So, when we think about things like climate change, it's very much in that perspective that the insurance, just to take an example of sort of putting that into practice, it's to think about not only insurance companies going to be, prudentially resilient to the risks to them from climate change in the here and now over the next year or so, but are they going to be, resilient over the long term? Are they going to be able to provide financial services to enable people to manage risk, in the long term? Is it a viable industry? So that's the sort of way that we look at it, Richard.
Yeah, just you open the door to that conversation around climate reporting, and the FMA and yourselves, the XRB are getting much more engaged and involved in the whole climate reporting piece. Just for the people out there, can you just frame up what's the role the RB has in the overall climate conversation and particularly in the reporting side? Yeah,
so no, it's a great question. So climate change is really important to us because of the impact that it has on our mandate. So our mandate doesn't change. It's around delivering monetary stability and financial stability. And so the impact of climate change is going to affect the economy. So it needs to be something we need to understand when we're setting monetary policy, because impacts of climate change will affect prices. They'll cause big relative price changes and the like. So we need to sort of understand it from that perspective. From a financial stability point of view, climate change is going to have direct impacts on the stability of the financial system. If you think of the stability of the insurance industry, their exposure to climate change, you think about the stability of the banking system, particularly the lending that the banking system is doing is against collateral that kind of needs to be insured against these climate risks. It's sort of at the heart of what we do. It comes right back to credit risk and liquidity risk. So it's something that we need to really understand. My sense is that the financial industry has got their head, is getting their head around this as well. They get it. It is very much a collaborative effort. It's one where we need to work really closely with others, not just the FMA and XRB, but national government, local government, other arms of the public sector. So it is very much one that's it's a joint effort. From our perspective, and we see this in terms of all the different risks that the financial system faces, what you measure, you manage. We all sort of know that from our own day jobs. And that's really been the issue. And so where we are with climate change is just we need to get better data, better information to understand those risks such that they can be measured and managed. And there are a lot of data gaps there. So, this disclosure requirements that you talked about, again, I'm at a conference in a couple of nights, an IMF conference, talking about how New Zealand is the first country to have mandatory climate disclosures in terms of how those risks, measuring them, how we're measuring them and managing them. And that's sort of consistent with our approach that we've always taken to regulation, which is disclosure is a really important part of it, along with the regulatory discipline and the supervisory and market discipline is that disclosure. And so we're just applying the same approach in a climate change context. The challenge is going to be we're so early in the journey in terms of knowing what is a standard way to do this, or what's an appropriate way, or what's going to become an industry standard. We're trying to do it in a way that allows as much flexibility as possible, such that we can all learn off each other and eventually get to a more standardised way that everyone's reporting their climate disclosures.
Fantastic. Look, we have time for a couple last questions. Just kind of interesting, you've mentioned a couple of times your connect and the RB's connect to the global community of central banks, and given your experience in the UK, I mean, what's your sense of the last couple of years, not so much about climate, but just broadly? I mean, what's your sense of how New Zealand, how we're placed, the conversations that you have that you can share in terms of feedback from other jurisdictions? Interested in that kind of more global view that you can bring to the table.
Yeah, it's a great question, and it's a really good community to be part of, and one where the communication's very open and there is lots of sharing, because we are, there's only one central bank per country, so you do have to sort of look overseas to have those conversations and learnings. I guess what becomes apparent is just the similarities and the differences. There are big similarities in that we're all facing this sort of global COVID shock and the impact that has, the Ukrainian war, and there's a lot of issues that are very similar, and we're dealing with the same issues. At the same time, there are all the local nuances which sort of start to explain, well, why is it that we've all taken a similar approach but slightly different in nature, and that can come down to the state of the local economy before this happened, a lot of history, the governance arrangements, a whole range of things. I think for New Zealand, I think the key differentiating feature for us was really our starting point going into COVID. So, I think I talked at the beginning about how post-GFC, globally, central banks had been in this environment of trying to meet their inflation targets from below, and trying to get back to around 2% inflation from below. We were one of the few, countries which, had managed to achieve that. Just before we went into COVID, we had core inflation at around 2%, and we had, the labour market was effectively at maximum sustainable employment when COVID struck. So we had that very strong starting point, whereas I think a lot of other countries were still, if you look across the ditch to Australia, for example, they still had inflation, outside the bottom of their target range, and there were others in that type of situation. So we had a stronger starting point. which meant in part that we were able to bounce back more quickly. We also had a stronger starting point in terms of our fiscal position, low levels of fiscal debt, which meant that our wage subsidy and the like could be very aggressive to help with that very initial support. So I think that's part of what explained our quicker bounce back than elsewhere. And then we've increasingly had our colleagues overseas looking to us, to share our experiences of being at the front of the pack in terms of how do you safely remove the stimulus that you've put in place, and how do you safely tighten conditions in an environment where it's, I think as one of your members mentioned, it's pretty tricky to have a soft landing in the environment that we're in.
Fantastic. Hey, last question. We're sitting here in 3 years' time, 2025. What's happened? What's changed? What's new? What's different?
It's a great question, and that's the horizon that we should be thinking about. For me, it's one about just thinking about our mandate, and for us, it's one where we've still got inflation, CPI inflation in that sort of 1% to 3% range. We've got inflation expectations well anchored. Our credibility is strong. The labour, we've got borders are open. We've got a strong dynamic labour market. We've had a lot of investment in the economy to start tackling some of these long-term issues that will help not only with our productivity, but thinking about sort of some of the intergenerational issues that we face as a country. We'll have not only a stable, resilient financial system that can cope with all the different shocks that are going to come along, and there will be, and we don't know what they are, but they will come along, and can do that while being competitive, innovative, and making sure that we include everyone in the financial system and have access to financial services. It's a nice world that I'd like to be part of in 3 years' time.
Yeah, thank you, Christian. That's amazing. I think that theme of bringing everyone on the journey is key. I think the theme of innovating, and there's been huge innovation through COVID for all of us, and kind of balancing that with being able to then execute and do it here. So look, with that, thank you hugely for lending your expertise and your insights. Fascinating conversation. And thank you to the people who asked the key questions that took us on that journey right up front. So I really appreciate that. And on behalf of all of us, Christian, we look forward to continue to work closely with you and your colleagues at the RB. And you mentioned the conference, which is always a free kick. Yep, it is on, and everyone is welcome. And I'm pretty confident this time we'll actually be in the room together, whereas the last couple of years we've been in this digital format. So with that segue, we are increasingly doing things in person. For those of you who want to join us in the Future Ready Advice Summit down in Queenstown in a couple of weeks, that is an in-person event as well as a digital one. We're delighted to have Nick Tuffley from ASB next week in a similar kind of economic macro conversation. I mentioned the Starts With Action this fortnight is all about financially resilient kids. Just amazing momentum in that campaign. It's just so fantastic to see the whole sector and outside the sector come together to really try and shift the dial. It is focused on Starts With Action because it is about what we do as much as what we say. But huge kudos to everyone involved in that. And of course, our Growing, which is our signature flagship show in September. The program's building really nicely. So folks, without further ado, that's what's coming up. Please feel free to join us. Christian, to you, once again, a huge thank you. Really appreciate you joining us today and look forward to the next conversation in September. In the meantime, everybody, at 9:30, enjoy the rest of your day. Tomorrow is the start of winter. Hopefully it's as calm and balmy as it is today on Waiheke Island. And we'll see you next time. Thank you very much. Kia ora.